Sweet. We're recording, apparently. Didn't record the voice on the last one, so sorry about the sound quality on that. But spend all this money on all this gear and still forget to press the button. Huh?
That's all right. Hopefully the content was good enough that people listen to it.
It's always good. So as long as your mug's on there, mate, they'll just sit there and watch it anyway.
We'll see.
Sit there and watch it anyway.
What are we chatting about?
It is a value add plays, mate. How do we add value to our properties? Why do we add value? What's the benefits? What's the pros? What's the cons? Where does it get us? How does it impact the portfolio?
Yep.
How does it improve the portfolio?
Can I even do it, or is it only for the most sophisticated, the rich? Do you need to be a property developer to add value?
Do I need to know how to operate a screwdriver? Yes or no? We don't know.
Probably.
We're going to find out.
Do you know how to operate a screwdriver?
I don't, sometimes.
Phillips or flathead?
Flathead's the go-to.
Yeah.
Just the paint can, you know? It's the paint can.
We're
waffling now.
No, just bear with us. Do you like to get on the tools at all? Like if you...
Fuck no.
Just like if like something needs replacing...
It's not worth my time, bro. Like I'd rather pay someone else who knows how to do it properly.
Yeah, because you'll probably
if I do it, I'll waste a weekend, number one. Number two, it'll be terrible.
Shit, yeah.
Then I'll have to pay someone else to do it anyway.
Twice as much to fix what you've mucked up.
Exactly. So, there's no point.
So, yeah, what we want to do is we want to kind of delve into the value add side of things. And so what are the common things that are attainable? And like I was mentioning there, some of them obviously for the more sophisticated investors. And what is the difference? Like, are we taking now a more of an active approach, or can you still be a passive investor and still kind of add value to your portfolio? And we might kind of kick off with probably the most common one and kind of the most attainable for the everyday investor, and that is renovations. So that can be cosmetic, it can be structural, it can be a minor, add a gyprock wall and convert a 3-bedroom home into a 4, or it can be a full-blown renovations where you're bowling the house over and going all over again, and anything in between.
Yeah, 100%. It's definitely something, a play that we've seen a lot of people have success with. There's probably two different camps that most people sit into. So I would consider myself a passive investor. And so what that means is like, I like to just kind of sit on the sidelines, let time do its thing. I don't necessarily need to get in there and make things happen and move. But a lot of people are active investors and they have more time and they are happy to spend their weekends getting in there with the screwdrivers and repainting the house.
Maybe they're a tradie as well. Maybe like they've got the skill set like you and I definitely don't.
100%. And then I guess within renovation itself, there's two different types of strategies that you could go down. It's renovate to sell. So you buy the place, renovate it and flip it, or renovate to hold. So you renovate, have the uplift of the equity within the property and then hold on to it and keep it in the portfolio. So do you want to work as to why you might choose one or the other?
Yeah, I mean, it obviously comes down to what your play is with that property. I've personally employed the kind of buy, renovate, hold a couple of times in my own portfolio. So obviously buying something that's potentially a little bit more run down, doesn't necessarily need to be uninhabitable, but maybe it needs a freshen up, some new floors, paint, a new kitchen, something along those lines. And then you can obviously add value that way. So rather than paying for a nice, shiny, finished product, you actually come through, maybe not you and I, but you engage someone to actually come through and perform those renovations for you with the idea that the property is going to appreciate in value and that your dollar in is going to get whatever it might be, 2x, 3x, actually quite difficult to find these days with the cost of trades, but an uplift. And so the money that you're putting in is appreciated in the property, and hopefully that can then get you to a point where you might be able to get the value back out, revalue the property, and position where you might have some equity that you might be able to extract out of the portfolio and then potentially go again. That's something that I've personally done within my portfolio, and that's kind of worked quite well for me.
Yeah, so a reason why you might do a renovate and flip is you might be stuck on borrowing capacity. So you've only got 800K that you could borrow. You want to do it on a decent 800K property. You've got an extra, 100, 200 grand worth of renovations that you could do, and you turn it into a $1.2 million property. And maybe you don't have any more capacity to borrow anymore, right? And so you actually need to flip to pull out those funds to help you keep going again. But in the same scenario, let's say you had a $2 million borrowing capacity, which essentially means you can borrow $2 million worth of debt. You bought the 800K property, you've spent a bit of money, you've turned it into a 1.2 million. And instead of selling, which means you're going to cop those transaction costs, which is about 6% on the way in, 3% on the way out. So it costs you money to trade on property.
Plus CGT.
You could pull out the borrowable equity that you've done. So if it was a $1.2 million property, and let's just say for argument's sake that you've got 800K worth of debt, you could probably pull out 980 grand or something like that. It might be 180 grand that you could extract. And then instead of selling and copying those transaction costs, you pull out the 180, you use that 180 for a deposit for property number 2, and you rinse and repeat, and it allows you to keep going again. So the reason why why you might use one strategy or the other is you simply just don't have the capacity to hold on to this asset and you need to sell to extract your funds, or you do have the capacity, you extract that and then use that to continue going and moving forward. Or another solution is like, you could couple this strategy with a play where you might be buying in like a regional area which is going through a season of really, really high growth. So maybe it's going through a 3 or 4 year cycle where, you know, demand's increasing. It might be because there's job opportunities there or a market that's increasing quite well. And so you might be able to renovate this particular property, uplift it in value dramatically, move with the market as well. So you're kind of getting this like double-edged sword, not double-edged sword, like two
double
swords.
Dipping almost.
Yeah, you're double dipping. And then you might go, okay, well, in 3 or 4 years, I do not feel like this area is going to continue to grow at the same rate that it was. So I might just get out, take my profits and ride with the wind.
Yeah, beautiful. The other kind of really common thing that we see with the kind of the renovation play, not kind of the necessarily the full-blown reno, is like, yes, that kind of position there where we can see a bit of capital appreciation and pull the money out to go again in terms of the equity release, but also the rental income piece, because usually the property that you might be buying, that kind of ugly duckling, and you've heard it all 1,000 times over, by the worst house in the best street. I almost got that wrong. So obviously the rental in that one will be starting out quite poor. And you come through and you give it a nice new kitchen, a lick of paint, or really importantly, if you turn a 2 into a 3 bed or a 3 into a 4, you're in a different price point in the rental market as well. And then that also then might make that property a little bit easier to hold for you long term. And all of a sudden you're kind of getting it up in line with where the market rent sits within the portfolio. So yeah, a couple of different ways in which you might be able to.
And that's a really good segue into like deciding what you want to do as a renovation. So Joey's touched on 2 things there. It might be, you know, adding a new kitchen bench top. It might be doing a new lick of paint, and that might be enough to get you an extra $50, $100 a week worth of rent because it's nice and new and people can kind of live in it. And it might only cost you, you know, $5,000, $10,000 to do that smaller type of renovation. But if your objective is to increase value, what we've seen work really, really well is, again, a scenario that you just mentioned is turning a 3-bedroom into a 4-bedroom. So if you go into an area and you see a 3-bedroom's worth, let's say $500,000, but next door there's a 4-bedroom and it sells for $700,000. If you have a particular type of floor layout that allows you to just put like one simple separator wall into it and turn it into a 4-bedroom, and the gap is $200,000, it might cost you what, you know, $15,000 to put a wall in, but you're all of a sudden increasing the value by $200,000. So, you know, when you look at doing these renovations, you should really be looking at the market holistically and going like, how much add value can I execute out of this? And I always talk about what's the least amount that you can put in to get the most value out. Yeah. Because with any renovation, if you are looking to renovate and hold, you know, those materials are going to depreciate in another 10 years. So you're probably going to be doing another renovation in another 10 years. So if you're just doing a renovation to do a renovation for sake, sometimes it's not even worth it. And run the maths. Like if the rent is going to increase by $50 a week, figure that out over a year and then go, okay, if I'm going to spend 10 grand on this renovation, but I'm only going to get, I don't know, let's just, what's, you know, $50 by 52. Now let's go. 50 by 100 is 500.
What? Yeah. Oh, yeah. 50 by 100,
yeah,
$5,000.
So half of that, it's $2.5 grand. So if you're spending 10 grand on a renovation to only get $2.5 grand back, and you go, well, it's going to take 4 years to get my capital back. These are really worth it. Like run the numbers and do the maths.
No, absolutely. And I think that you touch on a really, really, really important point there. And for example, I hear it bandied around a lot to go, 2 into 3, 3 into a 4-bedroom, and it sounds really kind of sexy and sophisticated, but it really comes down to what the floor plan is, and that's fundamental. And we've seen a few case studies with some past clients, and like every now and then we jump in and we actually have a look at the property, and I've actually seen, like, Craig, great, yeah, absolutely, that floor plan makes sense. When you kind of see something going, that's actually like a bit of a shoebox there, just because it's got a window. I don't know if you could be calling that a 4th bedroom. So just making sure that your floor plan actually stacks and it makes sense. And then are you compromising? Oh, great, you can turn it into a 4th bedroom, but now you have no dining room or living room because you've added that 4th bedroom in. And we've seen that happen.
Decrease in value.
We've definitely seen that happen. Yeah, exactly.
So
you touched on something there as well. Like obviously you kind of said that you're a bit of more of a passive investor. So this kind of buying and renovating and selling properties like almost becomes a business for some of these people, right? There's nothing wrong with that, but it's definitely hands-on.
Yeah, well, as we said in the first couple of episodes, like the transaction cost on property is really, really expensive. Like it costs 10%. So if you're doing this as a career, you know, you have to be increasing the value of these properties by probably at least sort of 30% to make it worth your time, actually be profitable, pay all the costs and everything else like that. And you really sneakily mentioned CGT before, but there's different ways that you could do it. It's actually something that you've done in your personal portfolio where you flipped principal place of residence. So there's different types of strategies that you can do where you could get CGT exempt and do it that way. And it might not even be like, you know, a strategy that you're like, this is exactly what I want to do, but when we talk about that big rock in the jar and buying the house, it's very easy to move in yourself and then go, or the wife go, hey, I actually want to do these improvements. And then you can, I don't know, I don't know if
I mean, for us, it wasn't about that. It wasn't a play to go, oh, we can buy this, it's run down, we can renovate it, and then we're going to sell it. For us, it was, oh, this is like a rundown property, therefore it was a more affordable than a more of a polished one. I felt as though we had the, I don't know, design eye to turn it into something that we were happy to live in. We renovated it and we actually lived in it, like genuine. Like it wasn't the strategy wasn't to get in, flip it, and not pay any CGT on the way out type of thing. So it wasn't that at all. It was to raise a family. So we had our first son there, and it was all about that emotional family owner occupier play. And then, like most owner occupiers, we're kind of like, oh, if we have another kid, it's going to be a little bit small and it's nice and it looked really, really nice and it was polished and everything else like that. So we decided to liquidate, and so we got a nice gain that was CGT exempt. And then we were able to use that gain as the deposit on the kind of the forever family home.
So that's a really good point as well. Like if you are trying to get into a certain market, I know you bought the house in the area that you did because you wanted to get into that market, right? But you were able to get in at a lower price point. You probably still had the good, fundamental quality property, maybe in a location in that area that you really liked. It was desirable with walkable areas and everything else like that. But you could get in that lower price point and make it nice for yourself, actually make a home that you wanted to. So it is actually a really good point to, if you are trying to get into a certain market and maybe you're capped out at a certain price point and can't get in on the higher range, but this allows you to get in at a lower price point and you can increase it. It doesn't have to be immediately, but maybe over the next year or two, it allows you access to get into that area.
Yeah, like we see it, I mean, more commonly than I probably would like to see in terms of like, say, a client comes and always, not always, but sometimes the big rock in the jar. Most times when you ask someone, oh, would you like to buy a PPOR? When would you like to buy it? And how much would you like to spend? It's I'm 24 and I would like to buy a $3 million principal place of residence in 4 years' time. This kind of PPOR renovate upgrade doesn't get enough traction because it doesn't sound very sexy. It just sounds a lot nicer to go, oh, I'd love to buy a dream home and spend $3 million 4 years' time rather than buying that entry-level property, adding some value to it yourself, living in it for a period while it's serving you, and then upgrading that. And yes, it does come with a really nice free kick, being that CGT exemption, which, like I said, at any point might be taken away from us, but at the moment it's one of those really nice tax advantages that you might be able to take advantage of in the PPO upgrade.
Yeah, I think it doesn't get talked about enough, really, because we're talking about this earlier today as well, just in terms of the difference between an investment property and a principal place of residence. And we're talking actually about like regulation within the space. And it's hard because most roofs over your head are somewhere that you live. And so how do you define if it's an investment or not an investment? And so I definitely think it's something that, you should take advantage of while you can. And that big rock in the jar, yes, it might impact negatively. It might have a bigger financial impact that you'd like. If it's something that you can afford to hold on to and you're looking to do an active strategy where you are flipping property, potentially living in it while you're renovating could be a really beneficial play.
Yeah, and I mean, I'm not saying this is something that you should do. I had an interesting story where someone was telling us about one of his relatives where they're basically just in the game of renovating owner-occupiers and keep progressing them until they got to the eventual dream home. So starting out with something entry-level, renovating it, living in it for whatever it might have been, maybe 24 months, getting into the next one, to the next one, to the next one, and taking that really nice big gain until the point where they're actually able to buy the dream home outright. But very active, right? Not for the everyday investor.
But that's a strategy, right?
Absolutely.
Like there's so many different strategies that you can execute on. And it's all about understanding what that end goal is. For them, it was getting into that dream home. And there's so many ways that you can get there. There's so many ways that you can do it. But doing renovating a principal place of residence, adding value every single time and being CGT free, like that's a great way to execute on it.
Absolutely. I suppose the one that's getting a little bit of traction at the moment out there in the kind of space, it's all about this granny flat addition to help increase cash flow, question mark over increased value of the property, which I've got my own kind of thoughts in and around. But talk to me. What are your initial views when I say the word granny flat addition?
Yeah, it's an interesting one. I mean, firstly, you have to have the room to be able to build the granny flat. Yep. Like it's not accessible to everyone that owns that type of property. And generally, if you've got more land, it means you're in the outer skirts or whatever it might be. One negative on the granny flat that we have sort of seen that not a lot of people take into consideration is like if you've got existing tenants in the existing dwelling and then you go to them and you say, hey, like we're going to chuck another property on here and you're losing the backyard, then you might actually lose rent off the existing tenants, and it's probably less favorable for maybe someone like a family, right? If you've got a family and they've got a bigger backyard or whatever it might be, and then you're chucking, some creeper in the back room. Exactly. It can be a negative. It can be seen as a negative, and it might lower the pool of people that you could potentially rent this out to.
This is where I was going to chime in and say in around the value add play. People think, I'm going to go and spend whatever 200 grand on a granny flat, and my property cost me 1 mil. I've put 200 grand on my property's now got to be worth like 1.5 because it's now got a granny flat on there. There's a certain, and this is where it really comes down to locations. So there's a certain demographic within certain locations that appreciate the granny flat. Maybe it's a intergenerational family where you've got grandparents, their kids, and the grandkids all living in one block, and it's fabulous because grandparents at the back and they can assist with looking after the grandkids, and that works. An investor, that also works because you got potentially dual incomes coming on the one lot. But if your predominant future seller and the one who's pushing up the values of the properties in the neighbouring houses are owner-occupied buyers, lots of owner-occupied buyers don't necessarily want creeper living in backyard, or they would just love a really nice big backyard to maybe one day put a pool in, or so that the kids can play soccer or football, whatever it is in the backyard, and all of a sudden we can't do that because now there's a granny flat there.
Yeah, and I mean there are positives.
Absolutely, they were the negatives. They were the negatives.
There, some people might not want a creeper, but they might want grandma in the backyard or something like that. So
hence where the name came from.
Yeah, or even kids. Like if you've got teenage kids that you don't want in the house, you can kind of segregate them out, even though you probably don't want teenage kids running in a separate house that's over there. So there definitely are some positives. Other ones are something like, you can generally get a pretty good yield off them, right?
Yes.
Like if it's only
this is the big one,
or 250K and you can get an extra 300-400.
Depending on where it is, like there's some in near where I live where you could potentially rent out a 2-bedroom granny flat for like $600-700 a week.
See, that's wild. That's crazy. Some people I've even seen like the principal place on the block is renting it like, 700 and the granny flat's at like 500.
Because it's newer. Yeah. Because the granny flat's nice, new and shiny, and the front house not necessarily. And I've actually had a couple of calls with some clients where they've gone down this route, and obviously this is not for everyone. In fact, it's probably not for most people. They actually live in the granny flat and rent the front house out.
Oh, right.
So then actually they've still got accommodation in the area that they want to live in, but their costs are basically subsidised by the people living at the front.
Yeah, smart.
Very smart. It's horses for courses, but the rental yield that's primarily the main reason why people are doing this. And it's maybe buying and adding a granny flat yourself, or maybe it's buying a property with a granny flat on there. It's generally because your rental yield is going to be high. You've got 2 sets of tenants coming through. You can start to talk about diversity in terms of your tenants. You lose one tenant, you've got another tenant there, so you should always have some kind of occupancy throughout the years. Whereas if you only have the one tenant and you lost them, then you're going to have no income coming through. So there's that through there. But there's a bit of a misconception in that people think that you buy a property, add a granny flat, it's definitely going to add value to the property. Usually, and I'm not a property valuer, but usually it's just basically the cost of that gets added to the value of the property. So it was a 1 mil, you spent 200, your property's now worth 1.2.
Yeah.
And be arguable as to whether that actually would be the case. But your rental income in some instances could be really, really high where the rental yield just absolutely makes sense.
Yeah. No, it definitely makes sense. And I think there's kind of like two really good use cases for adding a granny flat. One might be, instead of having to buy another 500K property to get the extra $400 rent or whatever it might be, you could do it for 2 or 300K.
Like you said, where could you go and spend 200K and get, like in the instance near where I live, where could you get $650 a week for spending 200K? You couldn't. Exactly.
It's actually a decent return. And then the second one is for the people that are like capped on their borrowing capacity and can't actually go and borrow and keep buying properties. If they had this granny flat strategy mapped out from the start, they could essentially have accumulated a number of assets along the way and then go, okay, now we're capped out and now we're going to do a series of granny flats over 3 or 4 blocks. It's going to increase our rental income by anywhere from $1,000 to probably $3,000 on a weekly basis, and they're just going to do it when they've got the cash available to do it. They don't necessarily need to borrow.
And that's a really important thing as well, right? It doesn't necessarily have to be the case that you go out there and you do it tomorrow. Like, as long as you're still fundamentally buying in a good location, because I think we've all agreed that is really, really important. If you are buying something that has, because not every block has the ability to put a granny flat on, if you are, it's generally something that, one, has potentially some really nice frontage to it. Secondly, it's more than likely what usually has to be on a nice big block of land. And these are usually the pretty good fundamentals that we would usually take into account when we're buying a property anyway. So I would like to think that block that you were buying is, one, in a good location, 2, has a really good land proportion, and potentially 3 has a pretty decent frontage to it, which, one, maybe kind of could sell itself to potentially development down the line for not maybe you to carry out, but for a future buyer to one day come through and pay top dollar for your property to carry a subdivision or something like that out.
Are they always on separate titles?
No, in most cases not. So you kind of usually gonna have them on the one title, but where you're kind of delving into now might be I was kind of segueing in through there as well, is in and around that next kind of value add play that we were talking about, and that's in and around the subdivision. And this is where you're kind of getting into that next level, I would say, of sophistication. Probably not gonna, it's not every day you see an investor, first time investor, go out there and go, I'm going to buy a splitter block.
Very, very true. But we do see this strategy quite often where people, and like I've heard a lot of people talk about this scenario and how they started. They essentially bought like a block of 4 or whatever it might be, live in one and rent the rest of the 3 out. And so you could do the same sort of strategy with a subdivision. So if you bought, again, an ugly duckling on the best street and knocked it down and turned it into 3 or 4 or something like that, again, you could just live in one. Same as a scenario of someone living in their granny flat and renting the main house out. You could live in one if that's nice and comfortable for you, and then rent the rest of the 3 out and be comfortable from that side.
Yeah,
as well.
I suppose the only thing with that is that it's going to require some capital, right? So it requires capital, time, effort that lots of people don't necessarily love to think about it. The end product sounds nice, but for lots of people, it's a kind of a little bit that next layer of sophistication, like I like to refer to it as. But there's a couple other things, right, as well. So we've seen some past clients as well buy a block and the house is situated potentially at the front, and you can do like a battle axe, and then the back gets subdivided and maybe built on. And then you've got another property there with some rental income coming through, or maybe sold, or maybe both lots sold, or maybe the back lot sold and then you've got no mortgage against the front lot, or you sell the back lot and then you've got your big deposit on the next acquisition. Or they're similar to the battle axe, it might be a side-by-side situation where you've got a bigger block, the house is potentially portioned over to the left-hand side, and then you just cut it straight down the middle, and then you got a vacant block there on the right, and you can decide what you want to do with that.
And again, this comes down to active and passive. Like sometimes we see people and have clients that are actually actively looking for the add value of that subdivision and going, well, in this area, I know that I can split a 800 square meter block into 2, and I can buy this thing for 800K. I can split the block and sell the secondary block for 300K or whatever it might be, and eliminate majority of my debt on my purchase. And they do that within 4 months. Like it's a great way to actively go like how is the best way that I could potentially lower the mortgage on the debt, or
maybe against a PPOR. You sell the vacant block down, for example, and then you use that, and then that's a big chunk off your principal place of residence, but super active.
Yeah, very
super active. If we kind of go that next layer of development, and obviously this is again more for your, it's almost it basically is your job at this point where you're going through and you're potentially bowling over properties and you're building brand new duplexes, happening a lot. In the part of Sydney that I live, some of the older homes are getting knocked down and councils are rezoning so that the minimum land size is getting smaller and smaller, obviously to try and meet their housing requirements, because obviously there's definitely no argument that there definitely is a housing shortage basically almost across the country there. So that kind of duplex build, and then there's the other kind of play there of knocking down blocks and putting up apartments however many stories high.
Yeah, it's definitely a more active play, and it is like it's a job then, and you're engaging a developer to do the build for you. There's costs involved. You've got to do full tenders and quotations and everything.
Profits
else like
usually
that.
higher.
Yeah, that's true. That's very, very true. So it is a different kettle of fish, a different ball game. Generally, we see like joint ventures and people doing it together.
Do you want to do one? There's a really good opportunity. I've just been eyeing it off for the last 4 or 5 hours. There's a really good opportunity, just waterfront down there. What do you think?
Yeah, I reckon. Let's do it.
Yeah, beautiful.
You got to front the cash? Or?
No, you are. I'll project manage.
So there's many different ways that you can kind of add value to the portfolio, to each individual in the portfolio, each individual property.
There's one more that's just come to mind. What about like just to get the maximum use out of that block that you have? Maybe you've got, I don't know, acreage, or you've got a really desirable block out in some wine country, for example. What else can we do with that?
100%. So there's lots of different things that you can do, and it's kind of like moving into not necessarily the commercial space, but it could be a commercial block of land where you start to run a business off that land. So it could be something like a wedding venue if you're in a nice winery country. It could start a winery. I reckon we do that instead.
That sounds good. That sounds good.
You could start
it with the profits from selling this thing off.
We even see it with like maybe existing warehouses or something like that. They add a mezzanine.
I was going to ask you this. So like people think, value add only for residential, right? And again, our friend Steve Polisi will tell you that you can definitely do this within the commercial space, right?
100%.
And it's like, for example, that common one that you just said there, commercial warehouse there, and you add a mezzanine floor in.
Add some extra space to it. But really all like with commercial, it comes down to, it's really based on the lease and how much rental income that you're getting off the land. And so if you're
net lettable
adding, exactly, net lettable area or other ways of generating revenue or income off that individual block of land, you're actually increasing the value of that block of land by doing so. And so like there's many different ways that you can add values to all different types of assets and ways of doing it.
Yeah, absolutely. And like, obviously for the more, I don't want to say amateur, but for the beginner investors, it might be that cosmetic renovation, looking for a nice floor plan where you could turn a 2 into a 3, a 3 into a 4. We've spoken about the PPOR, CGT, exempt, not a tax accountant, benefits of flipping that, obviously properly flipping in itself. We've spoken about the granny flat addition, the pros and the cons of doing that, subdivisions, development. So you can see there's a hell of a lot there that we could delve into in terms of the value add play, but they're just a few that we've kind of covered off on there, and we're going to bring on a few of our partners that kind of specialize within some of these spaces as well. So you'll hear from some industry professionals in some upcoming episodes.
And it's a really great way to like project your portfolio from the start. So if you are capped, maybe you don't have a big enough deposit for property number 2, it's a really great way to extract and bring out enough cash for property number 2. And it's a really good way to kind of wrap up and finish off the portfolio as well. If you're kind of capped on borrowing capacity and you can't really do anything more from a general like normal way of lending or anything else like that, as I said before, you can add those granny flats, you can get some more income off it, you can increase the value and extract that borrowable equity if you can, and the banks will lend you.
If only there was a platform you could model all this out on.
And then use that borrowable equity for a commercial property on a lease stock loan that you can get some different lending on. So there's different parts of your portfolio where you can execute on these add value stages. It doesn't have to be right from the start, it doesn't have to be a core part of the strategy and you have to think about it right away, but it's definitely something to think about before you sit down and go like, okay, well, we're going to do these plays first and then execute on that. Or we need more cash as a deposit, so let's do a hard renovation, increase the value, pull out the borrowable equity and go again. It's just a really good thing to think about before you go and execute on your portfolio. Say you do have that 1.6, as we were talking about earlier, to go out and buy. Instead of going, I don't have enough for 1.6, I'm just going to do an 800 and then wait 2 years till I have enough savings and borrow capacity to go. You go, I'm going to do the $1 million purchase. We're going to do a renovation, take it to 1.4, extract 250K worth of borrowable equity, and then we've got enough for purchase number 2.
Yeah.
So it's just a good way to think about as you're building the portfolio before you do that first purchase. If you're capped in some sort of resource, it's always either going to be cash as a deposit, cash flow, or borrowing capacity. They're your 3 resources, and you just need to juggle all 3 of them to make your best decisions in building out the portfolio.
Yeah, and I mean, this could be the way to increase one of them. You could increase the value of the property, you could increase your cash flow, and obviously if you were to sell the property, you could increase your cash.
Yeah, and your borrowing capacity.
Exactly.
And if you're increasing cash flow, I mean, you're not going to increase it by a heap, but you can increase your borrowing capacity by adding a fair bit of cash flow to the portfolio as well. So
beautiful. Let's go and look at that site across the road. See you guys next time.
See you guys.